The number one way that people consistently hit financial goals is to automate it. Because if you automate it, you don't think about it and it just happens and you're good. If you have to think every month, oh, do I have enough? Do I have it? Well, I wanted to do this, but then I got to do that. It's too many decisions, and then people will avoid making the decision, or other priorities might creep up and take over. So instead, like in the US and most places, you can take your paycheck and send part of your paycheck to one bank account and part to another automatically. Once you have the basics down of, I have emergency reserves, I have a good budgeting system going, all right, what do I invest in next? You have to look at what are your expected returns for that particular asset class. So you look at expected returns and the risk level. So expected return, what do I think I'll get out of it? And how risky is it? How likely is it to get that? So Bitcoin and gold is very risky, right? People think gold is safe, but it isn't, because the price will fluctuate by very large amounts in a very short amount of time. That's usually what, as advisors, we consider risk, is very short periods of time, very large price fluctuations in generally unpredictable ways.
Welcome to the Bricks and Banks podcast, where real estate meets real wealth. Whether you're building from the ground up or stacking your paper to the ceiling, Steph breaks down property power plays and money moves you can act on. From first-time buyers to seasoned investors, this podcast is your blueprint for financial freedom through real estate, business, and investment. Subscribe now. It's time to build your future. This is Bricks and Banks with Steph.
Before we dive into the conversation, I want to let you know that this episode is a paid partnership with BetterHelp. You know what's interesting? We all have these patterns in our lives. The ways we react when we are stressed out, hurt, or disappointed. Maybe shutting people out or walking yourself into exhaustion. Or that voice in your head that says you're not good enough. For me, it's shutting people out. And here is the thing. We know that these patterns aren't helping us. We can see them clearly, but breaking them, that's a completely different story. I used to think I could just power through on my own, that time will heal everything, or I just needed to be stronger. But the truth is, some cycles are nearly impossible to break on your own. Not because you're weak, but because you're so close to see the full picture. That's why having outside support, real professional support, becomes a game changer. When you have someone who is trained to help you understand why these patterns exist and give you actual tools to help change them, everything shifts. You're not just surviving anymore. You're actually on your path to healing. That's why I'm partnering with BetterHelp today. BetterHelp is on a mission to make starting therapy easier. They will connect you with a credentialed therapist who was trained to listen to you and give you helpful, unbiased advice, ensuring confidentiality throughout the process. You just get to fill out a questionnaire and you'll be matched with a therapist as soon as possible. And if that's not the right fit, don't fret. You can easily switch therapists at any time at no extra cost. To get started, head on to betterhelp.com/bricksandbanks. That is betterhelp.com/bricksandbanks to get 10% off your very first month of therapy. I'll make sure to leave a link in the description so you can get right on. Breaking the cycle starts with one step, and this could be yours. Going to therapy is not a sign of weakness. It's a sign of strength. BetterHelp makes therapy simple with 10% off your first month of therapy to help you get started. So what are you waiting for? Remember, you don't have to do this alone. A problem shared is a problem half solved. Hey everyone, welcome to another amazing episode of the Bricks and Banks podcast. Today's guest is someone who sits right at the intersection of money, meaning, and the future people are quietly worried about. If you've ever thought, okay, I'm doing well financially, so why do I feel insecure? This conversation is for you. Our guest today is Pollard. He's a principal at Great Path Planning and a trusted financial advisor in retirement, tax, and legacy planning. He has worked with families, business owners, and high achievers who look successful on paper, but are still carrying that deep-seated uncertainty about the future. What makes his work different is that he doesn't just plan for numbers. He plans for people, and he's here on the pod today to break down the concept of financial planning. I know when people talk about financial planning, they think, oh, you need to have like £1 billion in the account before you start planning. No, you don't need that. So Chris is here to break it down, what it means, how soon you should start planning your finances. So in this episode, we're diving deep into financial security and what all that entails, how it kills fear, the emotional side of things, retirement, wealth building, and everything that is required for you to build a future. So make sure to get a notepad because it's about to be a masterclass. Welcome, Chris, to the show. It's great to have you on the pod today.
Thanks. It's great to be here, Stephanie.
I'm really excited when I read your profile because I like talking to financial planning experts because you guys see everything from the highs, the lows, the haves and the have-nots. So you're in the best position to tell us what to do, especially when it comes to investment banking, pension fund, retirement planning. You guys see the back end of how these things even start off. So you're the best people in the game to give us the gist. But before we dive into the whole discussion, can you just give us a bit about your background and how did you get there? Have you always wanted to be a financial advisor or you just found yourself here by stroke of luck?
Well, definitely not by stroke of luck, but we do have a winding journey to have become a financial advisor. So I originally started in a military career. I went to West Point, which is the United States Military Academy. For those of the UK, that'd be more like Sandhurst equivalent, if you're familiar with that. So it's officer training, and then we go into the military, and I was in the infantry for a while and did operations planning as well. And then I got out of the Army and off of active duty in 2009 and started doing financial planning. I did some time in the National Guard, which is like part-time military on the weekends, and they could call you back if they need you for deployments. But I did that for a few years afterwards. But started in the military with an electrical engineering undergraduate degree, and then said, well, I don't want to design computers for the rest of my life, and I don't want to be in the military for the rest of my life. So what do I want to do? I want to help people, and I'm really like numbers, finance. So where can I do both of those things? And financial planning was a good fit for me. And I started working with military families who usually military officers, because they have reasonable salaries. They're not very high, but not very low, right? It's like middle class, upper middle class type salaries. And started working with those folks, and then started going into the wealth management after a number of years after getting a master's advanced degree in financial planning and business administration. So that's kind of my journey. About 10 years ago, I started my own firm. So I could just work individually with clients and don't have to work under a bank or anything like that. So it gives me a lot more freedom to just advise clients on anything they need help with financially, whether they have a real estate portfolio and want to invest that way, or they want to do stocks and bonds or just savings. I can advise on anything anywhere. And I have much more freedom to do that with me and my team now. So, and I've been running the firm for, like I said, almost 10 years now. So it's been a good experience. There are 3 of us in the firm now and a dog. So that's 4 of us. The dog isn't a planner though. She likes to sleep most of the time and say hi to people.
Wow. So when you branched out to do your own thing, did you like have a focus that, okay, I'm just going to advise on this particular asset class. I'm going to just cater to this set of people like middle class earners, or you were just like open to everyone? What was your strategy?
Yeah, when I started my own firm, I'd already been working for other firms for about 5 or 6 years, and I said, well, I really like working with folks that are about to stop working, and they need to figure out, okay, I've accumulated my money, and now I can't mess it up because I'm not going to go back to work, right? I'm in my 60s or 70s. This is it. Like, if we make mistakes with this money now, it's a big consequence. And then another group of people that started companies or businesses or own them, and then they say, okay, I want to retire. How do I get financial value out of the business while still transitioning it to either the next owner or the next generation if it's staying in the family, so that the business continues beyond me, right? Or beyond them. So that's the other group of clients I typically work with nowadays. But I've seen the scale of people with, businesses that are, in the hundreds of millions of pounds in revenue. And then I've seen clients that have almost probably £1 million of debt that they couldn't get out from under. So I've seen the spectrum, and I hope to take that and experience and share it on podcasts and things like that, because I can't work with everybody, right? So folks that are listening, we
Definitely.
could share the knowledge that I get to see from working with hundreds of people. And hopefully
Mm-hmm.
folks will be able to pick little pieces of what I've learned from seeing people over time.
Oh, that's really good. And so I titled today's episode "Wealth Without Peace: Why Financial Security Doesn't Kill Fear."
Yeah.
And thing is, a lot of people they've come from a hard time, a very hard background.
Yep.
So they make that money and they don't want to lose it. They're scared to even do anything with it. They just want to save it, save it, save it. At what point do you think people should start thinking of planning finances? Because some people will be like, oh, I just have $10,000 in my account. I just have $5,000 in my account. So why do I need to plan for that amount? It's so small. I need to
Yeah.
wait till like I have like $1 million to start planning my finances. So what's the sweet spots? What do you advise people to do? How soon should they start looking into financial planning?
I'd say we need to do some versions of financial planning when you have $0. Because part of
Mm,
financial planning is looking at the human life cycle and how do you interact with money in that particular phase. So when you first
okay.
finish school and you're said, okay, whether
Yeah.
if you just have your basic education, right? You finish primary school and secondary school, and then you're or in the US, we call it high school, right? And then what do we do
Yes.
next? Often people will say, well, what do you want to do? What are you interested in? And we can start to look at that, but we don't ask people, if you were to think about yourself 5 or 10 years from now, what would you like to be
Yeah.
doing? And then put yourself in your in the place of your future self. And they might say, well, I'd probably want to have a reasonable house and a car. Maybe I'll be starting a family or at least settling down or something, or maybe I get a pet, right? And what does it cost to live that way? Right. And how do we need to get to that? Because early on, career management is the fundamental skill of financial planning very early is don't accumulate a lot of debt when you
Yeah.
are first starting out, if you can avoid it, or if you do as little as possible, because a lot of us, if we don't have parents just giving us money, how else are you got to get your first job, you got to figure all that stuff out. And sometimes using revolving credit card debt or student
Mm-hmm.
loans, things like that, can start to add up and set people back financially. However, sometimes student loan sets you ahead because then you were able to train for a career that pays you more. So there has to be a
Yeah, that's true.
balance between how do I get started and where do I want to go? And sometimes we're just
Mm,
like, well, what do I want to do? And it's like, well, what do you want your life to look like? Then what you're interested in is it able to support the life that you want to live? If it's not, then we have to say, okay, what are other things I'm interested in that can support the life I want? Because sometimes what you're interested in, if it doesn't support your life, you'll eventually give up on it, right?
that's
Because you
true.
say, okay, I'm interested in baking, right? And, unless you're going to be on the Great British Bake Off and then get your own restaurant or something, making money
Yeah.
as a baker can be challenging, right? So
Mm,
do we decide to do that as a hobby, part time, or do you go all in on business ownership, right? What path would that take? So you see how it's not necessarily, oh, I have $1 million and now I should
yeah.
start planning with it. It's how do I manage my career so that I can live a life that I will enjoy and also build financial security? So there are basic skill building blocks of how do you manage a career? How do you develop a career? How do you get skill training? How much does
Yeah.
that cost? And that's where a lot of people kind of need to start because we all, I think, start wherever our parents started or the people that raised us, right? That's our baseline. And
Yeah,
that's
that's true.
why it can be fairly difficult for people to change socioeconomic status, depending on what country you're in and also the economic environment, because we start at our parents' baseline. So if our parents' baseline is on the lower side of things,
Yeah.
we learn their money skills. That might not be the same money skills or career skills that would get us to a level that we'd prefer to be at. And I want to say that socioeconomic mobility isn't a goal in and of itself, like just going up the ladder and
Mm,
saying, okay, now I'm a billionaire. Like, okay, what's the point? I think we all want to live better than our parents did, maybe, if that's our baseline, or the same, maybe.
yeah.
It's like some calibration of what we've seen, especially when we're young. That's our only point of reference. So sometimes we do have to take a hard look at how our family taught us about money and careers. And maybe those skills need to be adapted for what the economy is like now, where you live is like now. And you may have to
Mm,
go off the beaten path from what your family typically does. Right. My wife's family tends to do jobs that are more manual labor, or my wife's father was a police officer. So they tend to do more of those types of jobs. My family usually went to college, got master's degrees, did technical skills like computer networking or teaching, those kinds
Mm.
of things. So not saying that one is bad, one is good. They just have different pay scales that are associated with those jobs. And if you want to switch your pay scale, you might have to do things differently than your family did them, which can
Yes.
seem sometimes disloyal, maybe a little bit. And or you just don't know how to do it. And you say, well, that's just for these type of people, right?
Mm.
That these type of people are the ones that go to college or university and they get these types of jobs, but I don't because this is how my family always is.
Yeah.
So sometimes having that look about where do I want my life to go in a couple of years and what
Yes.
would I like that to be? And then start to backtrack. Okay, what steps would I need to take so that I can have a good career that is
Mm.
that has stability and grows me to where I want to be financially? And then makes it so I don't have to accumulate debt or just stay in the same family situation that I might have come from. Because that can be, it's very common to stay at a somewhat similar socioeconomic status to your parents.
Yeah, that's true because that is what you've always known your whole life. So that's a comfortable point. That's familiar.
Yeah.
So many people, when it comes to money, many people are reluctant to move to the uncomfortable. And like you rightly put it, when you talked about the contrast between your wife's family and your family, you guys are coming with different money background, money truths. And the thing is that the truth is real for both at both ends. So we can't discount your experiences. So
Right.
I understand that from your background, you've moved through very structured environments. You've worked in the military
Yes.
and you went into financial planning and all that. So how would you say that these experiences and these early experiences, how did it shape the way you now think about money and how you do business, leadership, and responsibility, especially when you're advising your clients about their financial future?
I think one of the things that one of the key skill sets that a planner needs to build out is using the strengths that you have as a planner to help your client while not
Mm,
bringing your own baggage to the table, right? So where you say,
okay.
okay, my family was like this, so your family must be like that too. And that assumption of that the client thinks about money the same way I do. So having a more open mind and asking the question, how do you think about money? When do you feel financially secure? So I have certain
Okay.
things that I feel financially secure when my bank has a certain amount of cash in it and when
Hmm.
my investment accounts are at a certain level. Like I have certain dollar numbers that when I'm below them, I get nervous. I just do. It's just part of my personality. And a lot of
Yeah.
clients have that too. Other ones don't care. And they could say, oh, I have $10 in my checking account. I'll just pull from that other account tomorrow. It's fine. And it doesn't bother them. Me, it's like,
Mm,
oh, I didn't have the money there 4 months in advance. So it's, I'm in danger now. So, um,
yeah.
everyone has a different approach to how they think about money. There are certain themes to them. So I think a
Okay.
key skill is okay, I can't bring too much of my own money personality to the clients, and I need to listen to what their money personality is and
Yeah.
what they need support in to achieve financial security, right? So it's a lot of listening skills as well as bringing the technical skills of knowing the law and how should you invest money in those technical skills. So it's this close blend of soft skills, which is a little unstructured, right? Listening to someone, having open conversations versus this is the hard advice you should do, which is much more military financial planning, spreadsheets oriented. And it's bringing the two together. That's kind of the beauty of this business that I'm in, right? Which is how can we
Okay.
make that money supports people's good lives and not
Mm-hmm.
that we just say, oh, you can't do that because the spreadsheet says it's bad, right? No, let's see what does the person want to do with themselves and what has meaning for them. And then
Yeah.
let's make sure the finances make that happen. And some people don't do well with structure. I like structure. Other people are
Mm-hmm.
very unstructured. So we have to adapt to, okay, is the client a structured, unstructured type person? How are ways that we can tweak how they're thinking about money or interacting with money to relieve stress for them?
Okay, well, that makes a lot of sense. So basically, you're focused on understanding the individual, understanding their money habits, so you can better advise them and position them on the right path. And I know that, like we said, people you like structures, but some people are better unstructured.
Yeah.
So, what's the common friction you see in your clients? Like you're trying to advise them to do this, but they're not tending to do differently. How do you manage such difficult situations in your
Yeah,
work?
the thing that we usually do is,
Mm.
and I want to just say this in general for your listeners, like think about how you think about money personally before you
Mm-hmm.
listen to the advice of a podcast or anyone on TikTok or whatever your YouTube, whatever you listen to and whatever you listen to, just know that you are coming from a certain perspective. And if you try to do things the way that someone else does it, just because it made them successful doesn't mean it'll make you successful. You have to find something that'll actually work with your personality. And some of those money habits, you might try to change them, but they can get very ingrained. So sometimes it's
Mm.
just finding the right fit with your personality and your money thoughts that'll supplement what you do, that'll get you in the right direction. And when we see friction with clients, rather than telling people what to do, you ask people and invite them into the conversation. And the reason why we do that is to promote agency, which is this means the person has power over their own life and they can make
Sure.
decisions. They can make good
Yeah.
decisions and bad decisions, but in general, they have the power to make good decisions that will be for their benefit and the benefit of people
Mm-hmm.
around them. So instead of saying you should do this because, you say, "Hey client, you want this to happen. There are a couple of ways we could make that happen. How were you thinking that this could happen?" Right? So invite them into the discussion. They might
Okay.
say, "I have no idea. Please tell me what to do." That's easy. Or they might
Mm-hmm.
say, "I was going to invest all my money in Bitcoin and then, hope that it goes up and then I'll retire." Or I'm going to buy gold right now is very popular because it's going up in price. So everybody gets attracted to it when it goes up. And then when it crashes, they
Yeah.
magically stop talking about it. So when a client says something that is an advisor, we'd say, well, you probably shouldn't put all your money in Bitcoin, right? Or all your money
Mm-hmm.
in stocks. You probably need an emergency fund and you need these other things. And then you just
That's true.
curiously ask questions. Okay, so you were looking to put the money here. What made you interested in doing that? And then the client will tell you. And then if the client is so far off base, because they may have been watching a bunch of TikToks and then they bring the ideas to you, which I've had clients do, they do it somewhat frequently, not too often, thank God. But then you'll say, in the past, I have seen clients attempt to do this, and sometimes it worked out and sometimes it didn't. Would you like to
Mm-hmm.
hear from me some alternatives that might be more likely to work out more
Okay.
consistently, right? So you kind of invite, but you're asking permission before you just say, "Hey, don't do this because that's dumb." That's not helpful because first of all, it's insulting.
Yeah.
Second of all, are essentially telling the client that they don't have agency and they cannot make good decisions for themselves. And maybe they can't because they don't have the skills yet. But that's also, as the advisor, why you're there.
Mm.
Inviting the client into conversation and then engaging with where they're at and then helping them get to the next step and saying, okay, to get to this next step to proceed towards, let's say a client's in a high stress job and they don't get to spend enough time with their family. Okay, do you enjoy the career? Yes or no? Does it pay the bills? Yes or no? Does it provide the free time that you want to spend with your family when your kids are young and they want to spend time with you? If the answer is no, and that's a core value for the client, that's really important to them. All
Mm.
right, is there another job in the same field that you could pivot to? Or do we need to do a career pivot? If we had to do a career pivot, would you have to go back to school? How would we pay for that? Do you see how it all goes to like a
Oh,
financial
yeah.
question, but you pull the
Mm-hmm.
thread and see, okay, how can we make the client's life better? And
Yes.
just follow the thread and then say, okay, maybe you have a bunch of savings and we really would prefer that it would be for retirement, but maybe you need to change
Mm.
careers because it's too stressful. It's affecting your health and your relationships, because your physical health and your relationships are the two things that drive happiness pretty much more than anything else. If you're not
That's
physically
true.
healthy, it's very difficult to be happy or even, let's say, content. Happy sometimes has oh, I'm happy all the time. It seems to have almost a negative connotation, right? Fake happiness. But then relationships are probably the number one driver of health and longevity over a human lifespan of who's the most successful. And it's because they had good relationships with good people that encouraged them in a good direction, right? And human connection is super important. So if your career doesn't
Mm-hmm.
allow for it, we may need to do some pivoting or manage the career better don't say yes to your manager every time they say you need to work all weekend on this thing, and say, no, that's not what I'm getting paid for.
Mm.
Or here's an alternative, right? If rather than working all weekend, maybe I'll spend 1 hour per day extra, or telling the truth that we need to hire more people if you want this project to be viable, right? So being able to stand up for yourself and manage
Okay.
your career is really crucial for people. So that's just some examples of how you engage someone and you can
Yeah.
avoid that friction of you should do this. No, we got to
Mm.
explore, what does the client want to do? What's meaningful? And they will do eventually what's meaningful to them. Because a lot of the times that conflict comes from the advisor says I should save the money, but I really want to spend it on my daughter's, education or a party, or them going to some dance classes or something, because she really loves it, right? So
Yeah.
what the client values is always going to trump what the advisor says they should do based on a spreadsheet. So you got to bring the two together to make them work. And then sometimes you just
Wow.
have to tell a client what you're doing won't work. And I'm trying to help, and I would like to find a way to make it work. What are some ideas that you have? Here's some ideas that I have. Let's work together on it. So collaboration, I think, is the number one way to avoid just putting heads over numbers, because it becomes almost like a argument with a significant other of like, oh, you never clean the dishes. Like, well, I don't never clean the dishes. I did it last week. And like, no, you
I
didn't. And
just
now
don't
you're
do it
arguing
all the
over
time.
facts. No, it's not helpful.
Okay.
Yeah. So
I like the way you've peeled back the curtain at what really happens behind the scenes, because right now you're telling me you're a financial advisor, you're an emotional coach, you're a
sometimes,
career coach. You're doing all this because at the end of the day, it's money really out. Money really plays a role in everything we do in life,
yeah,
all the decisions we make. And takes me back to one point when it comes to credit cards and credit building. What's your
yes,
take on that? Because some people are adverse to having a credit card. They're like, oh, I don't want to be in debt. I just want to pay off all my credit card
yeah.
and just do everything by cash. What's your take on that? Because I know some opportunities only open up when they review your credit score.
Yes.
How do you advise people to manage credit?
Especially when you're first starting,
Okay.
one of the best ways to manage credit is to get a credit card with a low balance, a low limit, like
Low limit.
$500, $1,000, whatever it is. Something that is almost insignificant in proportion to your income. So if you make $3,000 a month, get a credit card with a limit of 500. So it wouldn't be like insanely difficult to pay off over 1 to 2 months, because it's a relatively small balance. And then
Yeah.
you select a few items to always put on your credit card, whether it's petrol or gas for the car, or are you going to always pay your cell phone bill on your credit card? And then each month you have it automatically pay off. So that way you're using credit, you have credit open, but you are never paying interest, because you can open a credit card, and most credit cards are structured like this. There's charge cards, there's credit cards, there's two kind of different ways of handling it. The most common credit card structure is you can use it throughout the month, and as long as you pay it off by a certain date, you don't pay any interest. You're just borrowing money for a couple of days from them and you pay them back. No problem, no interest. That's the best way to start showing that you know how to use credit properly, which is I have some credit and I'm using it responsibly, which means I have $500 or $1,000. I maybe use $200 a month of that $500 credit card. So you're not using the whole thing every month. You want to use just part of it. Usually it's less than half. I think 30 to 40% is the ideal number, I think, for credit utilization. Depends on whether you're looking at FICO scores or whatever them. You can get a little too crazy in the weeds about trying to make your credit awesome. You want it to be good, but don't make it a life goal. Having a good credit with no cash is bad, right? Because then you just have to borrow money if you need the cash. Having a good credit with cash is really good, and it puts you in a great position to get a reasonable house at a reasonable interest rate, or not have to buy a car with cash. And you can, especially if dealerships and car companies have incentives on cars where you only pay 1 or 2% or sometimes 0% for a car, you probably should finance that, because inflation occurs every year, which means the price of everything goes up a little bit every year. So if your car payment's $300 a month and inflation is happening, you are still only paying $300 a month. So you are paying the bank back with money that's slightly less valuable in the future. So it's actually better for you, as long as the interest rate isn't too high. If the interest rate is low, it's very good to use low interest rate debt for things that you need all the time that are necessities, like buying a car, or things that grow in value, like a home or education, assuming that you're getting educated in something where you can actually get a job afterward. If you just do it in, like, if you're very interested in medieval literature, you might be able to get a job with that, but likely not unless you get a PhD and become a professor. Otherwise, the odds of making money in that are probably low. So it might not be worth incurring student loan debt to get a degree in medieval literature. So you might just say, okay, is it worth it to do that because I can actually get paid from this in the future? Is the balance there, right? Between those two. Using debt, not all debt is bad. Debt can be good if it is used correctly and in moderation in comparison to your income. People get in trouble when they run up too much debt in comparison to their income. or they don't build an emergency fund. So that way, if something interrupts their income or they have
Yeah.
unexpected expenses, then they can't pay the debt back on time. So those are the two things that really get people in trouble, is having no emergency reserves at all and
Mm.
getting debt that's too high in proportion to your income and any job that you are likely to get. Right? You may have one job
Okay.
that pays you really well, but if you left it, you couldn't find a replacement. That's not good, right? So we'd want to say, okay,
Yeah.
what's my skill level and what would I pay? What would I get paid if I lost this particular job and went to a different one? And that way you can right size how you're using debt in proportion to what's likely to happen for you, rather than, oh, it's really good today, so I'll just rack up as much debt as possible. Not a good plan.
Okay. That makes sense. And okay, in the context of that, let's paint a situation for like the Gen Z population. A lot of them are in the workforce right now, and lots of them are getting their advice on TikTok. So what is your advice in terms of saving, investments, and whatnot? Because at this point, they're just aggressively saving. Some are saving, some are using the money to travel or doing other things, or trying different things with their money. How do you advise them to structure their money? I know you talked about like building an emergency fund. What should they be doing with their money at this time, Gen Z?
Yeah. So Gen Z, what we want to do is look at what are the things you want to do with your life, like
Mm.
this year, let's say. Say, oh, I'd really like to go on a trip to Ireland, or I want to visit the US, or I want to go to France or someplace. International travel, if you are young and you don't have children to bring with you, right, is actually very good and very like fulfilling. However, it has
Mhm.
to be in balance with other things, right? So when we look at what are you bringing in as far as money
Yeah.
coming in, how would you like to apply that towards your life, both what you need and want today and what you will need and want tomorrow and in the future, right? Because future you might need some money too. So we got to think about the current version of you and the future you, right? And balance the two. So most folks, it's good if when they're take a portion of your salary, and if you have if you know you want to travel, put it in a side account for travel, right? And every
Okay.
paycheck, set it aside on a ongoing basis. The number one way that people consistently hit financial goals is to automate it.
Mm.
Because if you automate it, you don't think about it and it just happens and you're good. If you have to think every month, oh, do I have enough? Do I have it? Well, I wanted to do this, but then I got to do that. It's too many decisions. And then people will avoid making the decision, or other
Yeah.
priorities might creep up and take over. So instead, like in the US and most places, you can take your paycheck and send part of your paycheck to one bank account and part to another automatically. So you could say, okay, I want
Oh,
to
I
build
see.
emergency reserves. I'm going to put $100 a month towards my emergency reserves automatically from my paycheck. It's a separate bank account and it just sits there. And I know that that's labeled in my bank app as
Mm.
emergency reserves. And my target is, and then you pick a target for it. Usually we want people to have eventually 3 to 6 months of living expenses, not of salary, not of savings, of just regular living expenses to keep the lights on, be able to eat, be able to go to the
Mm.
doctor if you have to, all those kinds of expenses,
Yeah.
whatever that costs for you, and make, like, if you have a car, make your car payment. 3 months of that is a good starting point. And it's going to be, several $1,000s. A lot of people will get into find if people have in the US $10 to $15,000 in an emergency fund, that covers so many emergencies because they're very big emergencies if you're spending $10,000 on something. If you're
Yeah.
buying a car, that's usually not an emergency because your car's kind of dying and it's not going well, right? Or if somebody
Mm.
hits you in a car accident, you use insurance to cover it. That's not as much of an emergency as, okay, I own a house and a tree fell through it and the insurance didn't cover
Yeah.
any of it. That's an emergency, right? Or I don't have a job, I have to find a new one. So 3 to 6 months of living expenses is kind of a target. Most people 10 to 15,000 is a very good starting point. And it may sound like a large number, but all you got to do is set up that auto transfer and you won't miss it, especially if you get a raise at work. So if
Mm.
they
That's true.
increase your salary, what you do, you don't have to put all your salary to savings. Just say, I'm going to put
Mm.
half towards savings and half I'll spend on stuff I like. Or I need to move out of the place I'm living in now because the rents are getting too high or I don't like the area anymore. I want to be closer to friends. So you apply some of the raise to lifestyle, but also some automatically to emergency
Mm.
reserves. And then once we have emergency reserves, then we can
Yeah.
start saving for other goals like replacing a vehicle or retirement, or if we want to purchase something else, pay for kids' education in the United States.
Okay. That's very good advice. So take notes, Gen Z folks. So you should have your emergency fund setup, at least think of the goal for the first 6 months of the year of 2026 to set up your emergency fund if you don't have any. So let's look at the millennials. Millennials have that pot of cash sitting in their accounts. They've been aggressively saving over the last couple of years, but they're all frozen when it comes to investing. They don't know where to go. Some are thinking gold, some are thinking crypto. What are your top 3 investment vehicles you think people should be going into starting off investing?
Yeah. So first thing we do is we keep our emergency fund. You do not put
Yeah.
your emergency fund in investments. Investments are for long term. Emergency
Yeah.
fund can happen at any time. So emergency fund stays at the bank in a high yield savings account or a money market fund, right? That's where we keep emergency funds. So it's safe, but still earns interest, right? So it's low interest, but it's still interest. Then we look at when will you need the money that we're talking about investing. If you don't need it for 7, 10 years, we can put it in diversified stock funds usually, or ETFs in the United States is what we call them. I'm not quite sure what the British structure is for investments.
Same, ETFs.
Yeah, ETFs are usually good if they are very broad-based and not too fancy. And what I mean by fancy is you're trying to be really clever with what investments you select. And you say, oh, I know that AI is the future for everything. Or other people will say, AI is a bubble and it will all crash tomorrow. And there are ETFs that you can invest in that are anti-AI, right? That are inverse AI, or they're leveraged AI. If you're trying to be too clever with your investments, you're probably going to be wrong. So usually it's better to buy very broad-based funds. We call them index funds in the United States, which buys stocks off of a list based on rules. And those rules are very consistent and rarely change if they ever change. So you may hear like in the United States, we have the S&P 500 is one of the most common indexes to look at. So that's 500 large, profitable U.S. companies. It buys it off of a list. Occasionally, a company or two will get kicked out of the list because they're no longer profitable, and a couple other ones get added. Otherwise, it doesn't change, and you have 500 stocks. Or a lot of our clients will use a total market index. It means it buys every stock that is available to get in the United States that's publicly traded.
Okay.
So we'll have 3,000 stocks in the fund. And if one company goes bankrupt, we probably wouldn't even feel it. We wouldn't even notice because there's 3,000 in there. And over time, that tends to work very well. You don't have to babysit it and watch it all the time and try to be correct about, oh, AI is the future, Bitcoin's the future, gold's the future. Guess what? You have all of that mixed in because you have all the stocks that are available to you. And then you just buy the index funds and keep holding them and keep adding to them over time. Then when you get close to your goal happening, let's say you wanted to save for a down payment for a house. So you want to put money towards a house and you say, my target is $100,000, right? You would invest in that fund and keep putting money into it and letting the stocks grow. And sometimes they'll dip in value, but eventually we will hit our target of around 100,000. So when we hit the target, you either pull the money out because you know you're going to buy the house, or as soon as you know you're going to pull the money, pull it out of the market. Do not wait because the market can drop and it's very hard to buy a house with less money than you thought you were going to have, right? So if you were supposed to have 100,000 and now you have 70,000 because the market dropped 30%, oops, no house. Sometimes we get a little greedy, especially when things are going up. We think that they'll keep going up, and they often do. But sometimes we need to align the time horizon with what investments we're using. And if we start to get much closer to a goal, like something's going to occur in maybe a year or two, we probably want to have a lot less stocks, and then we start mixing bonds and cash in there. And then eventually, if you need within 6 months, need it for a house or a car or something like that, it's got to be out of stocks and into a money market earning some interest. And then the money will be there for your goal. So I'd say keep your emergency fund and then say, oh, next year, do I need anything I need to replace some windows in my house or paint it or something like that. Set aside that money as well. And then the rest, we start to look towards very broadly diversified investments that have low fees and low tax implications and are very broadly based. And that tends to work really well and be less stressful for most people than trying to put Bitcoin, gold, and then I have to day trade my account and be on Robinhood and all these other places and always picking the right thing. Yeah, it's stressful, and most people underperform the market by so much. They underperform the index funds by trying to be too clever. And if you just buy the thing and hold it, most of the time, it ends up being in your favor. if you were to just let it sit and also not have it sitting in stocks when you need the money, because that's just pure luck of, oh, the economy's bad the year I needed to buy a house. Well, it shouldn't have been in the market anyway at that point.
Oh, okay. That makes a lot of sense. And I've gotten this advice before. It said you should structure your bank account such that you keep this one for saving. You save, you spend from this other bank accounts.
Yeah.
You invest from this account. Is that a reasonable advice as opposed to putting all your money in one account and trying to sort things out? What's your
Most
take on that?
people find it too confusing to attempt to do all of it from one account, just
Mm,
because it's administratively difficult to know, oh, my mortgage or my rent payment needs to come out this day, but then I got to go put it over here in stocks. And
yeah.
how much money do I need to leave there? It's too much mental math that needs to
Yeah.
happen to have it in one account. And that's why most of the time we will say, here, have a spending account. Sometimes we'll
Mm-hmm.
actually have two spending accounts. Some clients like this. If you have a lot of trouble with budgeting and keeping track, one of the
Yeah.
ways to make this easier is to have two spending accounts. One is for fixed expenses that never change. So it would be usually rent, a car payment, cell phone bills, maybe electricity bills, because they're generally about the same.
Mm-hmm.
Maybe a little more in the summer or winter, depending where you are in the world, right? But
Yeah.
they're kind of fixed and the same and very predictable. And then you either transfer manually or have your paycheck put in the appropriate amount of money to cover the fixed bills. And then choice money is what we call it, or where's money where you go to the grocery store, you could decide to buy more or less of something. If you go shopping, you could decide to buy, well, I'm going to buy 3 outfits instead of 2, or I'll buy 4 instead of 1. It's choice money. And instead of saying, oh, I think I need this much for my rent, but then I also need to buy food, it gets too confusing with too many bills. So then you just say, okay, this month I want to spend $500 on food and I need to buy an outfit or 2 for work clothes. And then you
Yeah.
just put 500 in that account, and then you watch the account go down. And when it gets to a minimum threshold, maybe $100, $200, whatever threshold you want to select, then you stop spending. And that way it automatically budgets for you. You don't have to do spreadsheets. You don't have to use apps. This is one way to just keep track of variable spending where you kind of don't know, well, how much should I spend today? And you just look at your
Mm,
app and be like, oh, this is my money for the week or for the month. Automatically there, you just look and you'd be like, oh, that's safe to spend that money because I know my rent and other things will be covered from the other account that has enough money. And it's easier for a lot of folks to just do it that way. So some folks
okay.
like the two banks for spending, one for fixed and one for choice money, then the savings separate, then the investments after that. So it's like 4 accounts. And then in the
Okay.
US, we have interesting retirement schemes that are different than in the UK, but we have Roth
Yeah.
IRAs and traditionals and 401ks. So it starts to get,
401ks.
yeah, more complicated, but it's not uncommon for clients. Most of my clients will have a checking account and a savings account. The checking account is where they do everyday spending and also their
Mm,
fixed expenses. The savings is where we park their emergency fund. And
yeah.
then we'll have 5 other accounts, 2 Roth IRAs, one for each person, 2 traditional IRAs or 401ks, one for each person, and then a joint account if they're a married couple where it's long-term investment money and it's separate from
Yeah.
their spending money so that they can keep track of it. So it's not uncommon for clients to have 7 to 10 accounts covering all the bases. And this would probably be where most millennials are heading towards at this point.
Definitely.
Yeah.
Yeah. Amazing. So let's talk about business side of things, business investing.
Yeah.
A lot of businesses right now, they're looking into building their assets portfolio and they're looking into investing in real estate, investing more in the stock market, investing in other businesses.
Yes.
So how do you advise them in terms of prioritizing their investments?
Yes. So the choice of where to invest money, once you have the basics down of I have emergency reserves, I have a good
Yeah.
budgeting system going. All right, what do I invest in next? You have to look at what are your expected returns for that particular asset class. So you look at
Okay.
expected returns and
Hmm.
the risk level. All right. So
Okay.
expected return, what do I think I'll get out of it? And how
Mm-hmm.
risky is it? How likely is it to get that? So Bitcoin and gold is very risky, right? People think gold is safe, but it isn't because the price will fluctuate by very large amounts in a
Exactly.
very short amount of time. That's usually what, as advisors, we consider risk is very short periods of time, very large price fluctuations in generally unpredictable ways. That's what we consider risk. It's one version. The other version of risk is how likely are you to lose all of your money permanently?
Okay.
Right. If you buy 3,000 stocks, one of the stocks might go away and you lose 1/3000th of your money, right? That you won't notice that, right? But
Yeah.
if you bought 5 stocks and 2 of them went out of business, we have a problem, right? You've lost 20% of your money at that point, and it's gone permanently because they went out of business, went bankrupt, you're not getting any of it. So knowing the risk, how likely are you to permanently lose money, and how likely is the price of it to change very rapidly and unpredictably, is how much risk we're willing to put up with in order to get the return. Because if all you need is your money to grow at 3 or 4%, in the US, we can do that at banks right now with no risk, and it's FDIC insured. So the government will back it. So even if the bank fails, you'll get your money, right? But if you're trying to grow it faster, you have to take some risk because there's no free lunch. Nobody's giving out free food to everybody, right? You got to pay for it. So you have to be willing to put up with some risk if you want to get higher rates of return than that. So you look at the investment, consider what is likely to be the outcome for this investment, and then you decide how much do you want to put towards it. Because sometimes when you put money towards it, it locks your money up for a while, like especially if you're buying a business or something like that directly, not just stocks, because you can get out of stocks very quickly, like the same day sometimes. Buying a business, you're kind of stuck with it for a while. Or buying real estate, it takes a while to sell it, right? And there could be problems with it. So there's timing issues with it, and we call it liquidity, which means how fast could you turn that into cash? A building or real estate in the United States, if it's like a regular single family house, it'll probably be 30 to 60 days to sell it, right? If things are going well. If things don't go well, it could take 6 months to sell it, right? So you'd say, okay, if I'm investing in this and it's not going well, how fast can I get my money back out, and how much am I likely to lose, right? So you look at what am I likely to make and what am I also likely to lose? Both. Most people just look at what they're going to make, or they'll look at only what could I lose. They don't look at both. When you look at both, you say, okay, is this fair to me? If I'm going to put my money in this, is it fair to me? Which means I'm taking risk, and I could make money, I could lose money, but it's generally proportionate or in my favor, then I'll do it. A lot of people, like millennials, would be saying, like, they're just sitting on money and then they don't know what to do with it. And they're like, well, I could lose money in the stock market, so I just will do nothing. But you could also double your money in the stock market after a certain number of years, and you would miss out.
True.
So let's look at both, right? And a more balanced approach tends to be helpful. And that's how you select, okay, should I put money in real estate? Should I put it in stocks? Should I put it in bonds? And the other thing is, how much does your investment impact your life? Do you have to spend tons of time doing this when you should be spending it with your family, or you should just spend more time on your career and then you would get more salary and then you could invest the salary? Like, maybe it's better to do that than to just be spending a ton of time attempting to run rental properties in a city where the rent to value ratio of the homes is not good to invest in anyway, right? And it takes a ton of time and energy, and you're stressed out, right? So the stress level and time maintenance requirements are another key consideration.
Okay. I like the way you put it. And one of the biggest deductions when it comes to salary is retirement fund. A lot of people, when it comes to pension and retirement, they just black out. They'll be like, okay, yeah, later, whatever. So what should people be doing about their pension funds? Should they be bothered about where the company is investing that money? Or should they just take the laissez-faire approach? Like, okay, yeah, when that time comes, I'm going to cross the bridge. What do you think people should be doing more concerning their pension? Because it seems like it's just a black hole. We put our money there.
Yeah.
So like when we have no teeth, I'm like, okay, yeah, I think I have some savings.
I think, yeah. So we'll talk about the differences between the US and the UK pension systems here. But in the US, we have a couple of different things. Most companies don't have pensions anymore, which means you are responsible as the individual for providing most of the money you need in retirement. And then we have Social Security, which we all pay into throughout our working career. And then when we hit certain ages, we get checks from the government based on how much we put in and when we take the money out. So those are the two components in the US system. A few clients still have pensions, but they're very far and few between. In case you're allowed to select your investment options, and you can say, okay, I want to be more stocks, less stocks, those kinds of things. But a lot of those in case give you index funds options as well. And then you could just select those just like you can with a regular investment account. So, and then in the UK, do you have choice of where you can put your pension money, or is that all controlled? Because in the US, our pensions are usually controlled by a manager, and sometimes you don't have choices with how they invest it. So some do and some don't. It depends on the pension plan. So what's common in the UK? Do you know?
Yeah, it's mainly controlled. So that's why I'm like, people don't bother. They just like let it go automatically.
Yeah. Yeah. If there were a choice,
Okay.
then you could select risk level, and then what you try to do is don't just go for the funds that
Okay.
did the best recently, because that doesn't
Mm-hmm.
show you what does it tend to do over very long periods of time is what matters.
Yeah.
So then you got to go for funds that are tend to be more consistent and reasonable rates of return as well. We're not looking for somebody that does really well one year and then awful for the next 5 years, because that can happen a lot. If you have the choice, if you don't have the choice, then you're just relying on the pension manager, which we have
Mm.
similar setups as well. Some companies and do have similar where they has a pooled investment account for everybody that's retired, and it's managed
Okay.
by professionals. And then if they aren't doing well, they get fired and new ones get put in place.
Okay. I know we've talked a lot about financial risk and the financial side of things, but we don't, as financial advisors, we don't lay emphasis on the emotional risks part of things. And that's one thing you're interested in. So, in your experience, what are the hidden costs of being overly conservative in retirement? Not just financially, but in terms of regrets, relationships, and the quality of life.
Yes. So a lot of clients will try to use the same habits that got
Mm.
them to retirement in retirement. And some of those habits
Okay.
are helpful and some are not. So being frugal and consistently saving is usually very helpful for people. However, when
Yeah.
you're retired and you're trying to pull out of your investments and live on those and still enjoy life, sometimes the frugality mechanism will override their desire to see their kids or grandkids, right? And then you have to sometimes
Okay.
remind people of we've generally, over long periods of time, you're going to be in good shape based on where your finances are.
Yep.
And we can make adaptations along the way. But if you were to make choices between, let's say, going and seeing grandchildren or going to like Europe on a vacation, which would you normally prefer if you could only do one or the other? And you ask the client, and they might say, "Well, my grandkids are in college now, and they love me, but they don't really want to see me, so I'm going to Europe." Right? So you ask the
Yeah.
question, you don't assume, right? But then they say, "I'd much rather spend time with my grandkids." So then you say, "Okay, if things aren't going well in your finances because the stock market's crashing or unexpected things happen, we could just
Hmm.
skip a vacation 1 year or 2 years and then do it later, but you still see your grandkids, right?" So
Okay.
knowing that people can adapt and then
Hmm.
showing them where they can adapt, right? And saying, well, what do you think is flexible in your retirement budget? And they say, well,
Okay.
often people say their travel, and the other thing will be home renovations. Well, they don't have to do them all at once, right? I don't need to replace the whole kitchen and the windows and paint the outside and do a new driveway and replace, add an extension on my house all in 1 year, right? We don't have to spend 200,000 a year, or maybe we should, right? Because it's
Hmm.
affordable and it fits their financial life. So it's kind
Okay.
of saying, all right, if things don't go well, where would you adapt? Do you have room to adapt? If the answer is no,
Okay.
then maybe we should be a little nervous, right?
Hmm.
Because if there's no room for
Okay.
adaptation, then we probably do need to use those skills of being frugal. But a lot of clients will have room and they just won't use it because they don't feel free to do so. And then we may have some regrets of, man, I wish I'd spent more time with my grandkids when they were young, right? And had a good
Okay.
influence on them and helped them. The other thing is clients will start to say this when they get a little older, usually it's, I would like to see my children and grandchildren enjoy money that I give them now and do it together rather than just give them money when I'm dead. So
Okay.
saying,
That
okay,
makes
we're going to
sense.
go on family vacation together and grandma's going to help cover the plane tickets, right? Or
Hmm.
she'll pay for the dinners, right? So helping and doing things and having connectedness, that tends to be very meaningful to clients rather than saying, oh, I'll
Okay.
give my kid $1 million when I'm dead and hopefully they don't waste it, you know? So that's another way that we can prevent regrets is helping clients to use it for things that they enjoy and promotes connection, human connection in particular, tends
Okay.
to be very meaningful. And if you just ask someone what they find valuable and important, if you ask it right,
Yeah.
people are more than happy to tell you what they're interested in, right? And you just curiously ask questions and then you say, if it sounds like you've always wanted to learn to paint or you've been painting,
Hmm.
would you like to do a couple of painting classes? And they'd be like, oh, that would be great, but I don't know if I can afford it. And then what I do as the advisor is I will send you money from your investment account every month to cover the painting classes automatically.
Wow.
You don't need to worry about it. Just go do it. And then we try to give the client permission. I don't need to give them permission. It's their money. But sometimes they just need to be told it's okay and just make it automatic, right? That automatic thing of I'm going to do things I enjoy and are meaningful and I'll make
Yeah.
it automatic so I don't have to overthink it.
Nice. I like that concept. It helps to, you're not just helping them to manage your money, you're teaching them how to spend that money wisely and use it to improve their quality of life. So I know you've worked with so many families. So what do you think is the most common retirement planning mistake they make? And it doesn't look like mistake immediately, but these things quietly compound over time. What's that common retirement planning mistake you see often?
One that we will see in particularly more expensive parts of the country. So this is going to be more in major
Yes.
cities,
Okay.
and you probably will see it in London too, where people will be very concerned with paying off their house mortgage, but not having any
Mm,
cash. So then you have, it's what I call house poor. You have a beautiful house, but you have no investments and no other money.
mm,
So this can create maybe you have your pension, but that's it. So you have a fixed income and then a gorgeous paid off house. So we need to have some balance between sometimes it's okay to carry a mortgage into retirement as long as it's reasonable in comparison to your other sources of income and your investments. It's often less stressful to have several $100,000 or $1 million in your investment account rather than $1 million parked in a house where the only way to get it back out is to sell the
just to
house
sell it.
or to get a loan against it, right? And then we're using lines of credit and
Mm,
collateralized loans or mortgages again, which can be a little harder to get when you are retired because you don't have a job anymore. So
that's true.
that's one thing that some folks will do is they just get very focused on, I want to be debt free, debt free, debt free. Well, just make sure you're not so debt free that you're also asset free, cash free as well, or
That's true.
investment free. Yeah, you don't want to be cash free.
Okay.
So a balance between where is my money sitting? Is it sitting in a house where I can't get it? Or is it sitting in
Mm,
a bank account where I can get it? Or a mix of both? Usually a mix of both is what works. You don't necessarily want to
okay.
take $1 million mortgage into retirement. I mean, unless you have that kind of money, but sure. But maybe a balanced approach is probably a little bit better for most people. And that way, if something bad happens, like let's say something damages the house and you need to spend some money on it, you have the cash to do it. It's a lot
Yeah.
easier to find, let's say a mortgage payment is $2,000 a month. It's much easier to find $2,000 by doing part time work than it is to find $400,000, right?
That's
So if
true.
you have $400,000 in your investment account, you could always take 2,000 a couple of times if something got messed up with the mortgage payment. You could easily cover it. It's much
Mm.
harder to go and say, "Oh, I have a tree fell through the roof of my house. It's $40,000 to fix it." Well, where are you going to get 40,000 from? That's much harder to get that large amount of money. So you having liquidity as the individual is usually much more stress relieving and often better than just saying, "Oh, it's all tied up in the house, and I hope nothing happens because I can't get it." My kids will enjoy it when they sell my house, and then
Yeah.
they get it.
And it becomes a burden because you now have to start speaking with people to sell the house. It just takes longer than normal. So,
Yes.
yeah, like you said, there should be the balance between being assets rich and being cash rich because
Yes.
you don't want to tie up all your money in assets and be left with nothing.
Yep.
So, I know we talked about coming from money, the backgrounds that shape our money ideas, and you're changing that narrative because you're trying to let people know more about how to intentionally plan their finances. And these conversations can be really tough because it takes a lot of unlearning and relearning and passing on that new learning to your kids.
Yep.
So, what are the practical ways family can start having healthier, more honest conversation about wealth, aging, and the expectations before the whole tension rises? Because money is one of the biggest factors in, especially in terms of that causes divorces or
Yes.
breakdown in families. So can people have more optimistic conversation about money?
Yes. I'd say with divorces, money isn't necessarily the cause of the divorce. It's
Mm,
the catalyst that
okay.
it's the spark that made other communication and value problems explode. So it definitely causes
Okay.
it, right? So the money sparks it, but it's not the gasoline or the petrol that blows up, right? It's the spark, it's not the gas. It's not the dynamite,
Okay.
right? The dynamite is usually when you hear your partner say something or your parents say something, what they're saying and how you interpret what they say are two different things. So
Okay.
this is where what we call active listening or reflective mirroring comes into play. So your spouse might say, "We're spending too much money, we need to cut back." And what you might hear is an accusation of, "You're spending too much money and you're wasting it." And you might be the one that buys all the groceries and then you say back, "Well, if you weren't such a fat person and you won't eat all the time, I wouldn't have to buy so many groceries," right? And it's like, and things explode, right? So
Yeah.
that's an extreme example, but the assumption was when my spouse brings up a concern, they are attacking me rather than we're on the same team and how can we work together? So giving someone grace and assuming positive intent when you're having money discussions is step one, is assume that the person is not attacking you. They are expressing a concern. So then you want to
Yeah.
reflect back to them and mirror back to them what you think the concern is. And if you don't know what the concern is, ask. You can say, tell me more about that, or what makes you bring that up, or what makes you feel that way, right? Not why do you feel that way, because that can be accusational. What makes you feel that way? So open-ended questions and reflecting back. So you might say, "Oh man, the bank account balance is really low. We need to like focus on our budget more." So rather than an explosion of, "Oh, if we were to focus on our budget more, what do you think that would look like for us?" Right? So you see it's
Okay.
us working together, open-ended, cooperative. And then they might say, "Well, we got to do spreadsheets." And you might not be a spreadsheet person. So you might say, okay, spreadsheet, you would like to do spreadsheets. I hear you, and I know that you like spreadsheets a lot. That doesn't,
Yeah.
I tend to not do well with spreadsheets. So maybe I could do this. And then you bring alternatives or you ask for alternatives. So you see, it's that collaborative approach, open
Okay.
communication that is
Mm.
assuming positive intent, assuming we're a team and that we want this to work out well together. And if I don't know, my whole family back in the day was from England and we're known for being like very stoic, right? So it's like we don't talk about feelings and emotions. And if we do, it's because we're yelling at someone, right? So, and sometimes people will only hear their parents or family members discuss money as a point of stress. Otherwise, they never bring
Yeah.
it up. So
That's
they
true.
may have an internal, almost like a smoke alarm, that if the word money is brought up, that means my partner is distressed. And then
Mm.
the guard goes up. So you may have automatic things that you don't even know you're doing. And instead saying, okay, I'm going to step back. My personal reaction is I'm being defensive. Instead of being defensive, what is my partner trying to say? And then how
Mm.
can we work together and have an open communication about it? There is no magic bullet to this because it's communication skills. It's not as much money skill. It is. It's both. It's like a communication
Yeah.
plus money, which is higher stakes. And I think that's why when they say money causes divorce problem, causes the divorce, it's really communication problems. And then you throw money on top of it, boom, divorce. So it's really a more
Okay.
fundamental issue, I think, in a lot of ways. And then when you do have opposite money values, that can be very hard to come together. Like, hey, we never
Mm.
plan. We always just spend money because my family, if we had it, we spent it, right? And then your spouse's family might say, okay, we always save money. Those two coming together are going to miss each other a lot. So how can we make everything align or develop something that works well? And it often takes a lot of iterations to making it work. And sometimes it's not the ideal solution we're looking for. Sometimes
Yeah.
80% is good enough.
Okay. Amazing. I know you talk more about these concepts in your book. Can you share about your book and what you're trying to use it to achieve in the world?
Sure. So
Yeah.
my book, Untangling the Golden Knot, is about why people who probably do have enough money still act like they don't. And they're worried about it all the time. And maybe
Yeah.
they're like, I could retire and my pension is good and I could be fine, but I'll just work a couple more years and a couple more years and a couple more years. And 10 years later, they're still working when they said they were going to retire in 5 a long time
Yeah.
ago, right? So, what can we do about it? And what are the practical things that tend to relieve stress when
Mm.
people are thinking about their finances? So, what we did was we looked at notes from client meetings going back years and years and say, well, what did people worry about in
Okay.
these meetings? What do they always ask about? And what
Mm.
tended to relieve the stress and make people feel more at peace with money. And we try to put those ideas in the book and also give people practical exercises to develop their own ideas. Because what would make me
Mm.
feel at peace about money is not the same as what would be for you, most likely. But there's some
Mm-hmm.
common themes, right? So the book is designed it tells a client story, discusses that
Mm.
topic or that client common fear, and then gives you a little work space for each chapter. And they're very short chapters, 5 to 7 pages on a topic. Then a little workbook
Yeah.
that says, okay, I'm worried about money because, or my parents thought about money this way and that affects me. How? And then what do I want to do about it? If I were to change that, how would I like that to look? So it's going to be exercises in every chapter that say, what are the things you worry about with money? And can you do some things to feel more at peace with money? And that's what we're trying to do is make people see money as a tool to live a good life and
Yeah.
do good for themselves and the people around them, right? And a tool to do that. And fear worry tends to make people clamp down on the use of money or make mistakes rather than saying, I can openly, like a farmer, you put your seeds out in the field to grow and multiply and produce abundance. If you just hoard all the seeds, no growth will happen and eventually you run out.
Nice. That's really good. That's a really good book. It's one to watch out for. You called it Untangling the Golden Knot.
Yes.
And the
Yep,
golden
and it's
knot
available
is
on Amazon. Yep, is the analogy. We're trying to untangle the golden. I'm trying to make this thing work, but it's all tangled up.
Yeah, that's amazing. So I'll make sure to put the link in the description so people can just go and grab that book on Amazon because it's one to read for the year. Add it to your reading list for the year, guys. So before we wrap up, I like to ask the legacy question. So given your time at the Great Path, at your company, Great Path Financial, and all you're doing with preaching the gospel of good money habits, what would you like to be remembered for in 10 years, 20 years down the line? What would you like the name, the brand Chris Pollard to be remembered for?
I want people to feel that if they felt stuck in life, that I was I was instrumental in helping them get unstuck or unafraid about living a good life. And that just opening the door for them. I don't have to tell them what to do. I need to just help them open the door, unlock the key, whatever it is. We just got to find the thing or the couple of things and work on it together to open the door to living a good life and then aligning money so that happened. But it's really more about the caring aspect and walking alongside people that they felt Chris was with me the whole way, right? Or Great Path team now is a team of 3 of us. So they were with me the whole way or through the book, whatever you want to do. That impact was we have less stress and fear in the world and more abundance and thriving in the world. That's really what would be meaningful for me.
Amazing. So that leads us to the second segment. It's called the Firecracker round.
Yeah.
This is just me asking you a bunch of questions and you hitting me right back with the first answer that comes to my mind. So are you ready to play the mini game?
Let's do it.
Yeah, drum rolls. So the very first question, what's the single financial move that creates the most peace of mind? Like, what is the first thing you tell your clients that they need to do financially to bring that calm?
Have an emergency fund.
Emergency fund.
Always set it aside. Don't touch it unless it's a real emergency.
Yeah.
Because then you know, okay, I'll be okay.
Okay. So the emergency fund has to be in a high yield savings account, right?
Preferred if it's there, yeah. So that way you're just getting some interest on it and it doesn't sit. Because you are letting the money sit for a while until an emergency comes up. And you might not see an emergency for 5 years. So you might as well earn interest in the meantime. But it needs to be safe. It really shouldn't be in stocks or more risky assets because it's harder to get it back out and it might drop in value. So, solid emergency fund and cash buffers at the bank. Call it a cash buffer. It's like a bumper for your car. The bumper's there, so if you hit something, you don't get smashed. The bumper gets smashed, right? So we need a crumple zone for your money, and that's provides a lot of peace of mind for people.
That's good. So what's the most damaging myth about retirement?
The most damaging myth about retirement is that it will be easier than the rest of your life, because it is not.
Oh, really?
Yeah.
Really? How so?
It is not easier because most people will have been doing most people in the US have 2 to 3 different careers now, but they probably were working since they were in their 20s or teens even. And now all of a sudden, 50 years later, they're going to stop doing what they've been doing almost every day for 50 years. And particularly men in the United States build social circles around work. And they may not have as many friends outside of work. So particularly men start to have issues with social connection. And then they may rely more on their spouse and sometimes drive their spouse crazy because they can get clingy to their spouse because they don't have any other friends, right? So that transition into retirement is quite challenging for a lot of people. And some people, and I've had clients who have deployed to combat zones and, been in the army and, all that stuff. And they say the transition to retirement for them was harder than going to a war zone mentally.
Wow.
Because in a war zone, you have a clear direction. You know who the enemy is sometimes, most of the time.
Yeah.
And there's more clarity. Retirement is you make it what you want. It's the paradox of choice. If you have too many choices, it's very hard to make any choice at all.
That's true. Okay. I never ever thought about it like that because, people already paint retirement as This moments where you're free, you can do whatever you want, you can just sleep all day. I'm retired, like I'm free. And yes, I understand it because people now get confused. What do I do with my life
Yeah. And
at
also,
this point?
wouldn't it be great if we could experience some of that freedom before we were retired? Like, why do we got to wait 50 years
Exactly.
to do it? So could we
Yeah.
plan financially to have freedom along the way?
That's a very good one. I've never thought about it that way. Because I had a podcast last year where the theme was to retire, graduate. That was the message from that
Yeah.
in author. It was like, we don't have to retire. Retirement is a scam. Peg it at that pedestal that, okay, this is where you get to your peak, your utopian destiny.
Uh,
But by the time you get there, it's not worth it. So your goal in life shouldn't be to retire, because by the time you're retired, you lose purpose because there's nothing for you to do. You basically lose your mind.
Yeah.
So it
Some
means you
people, yeah.
should graduate. So graduate from life at that point and do something else. Find something else to do. So that
Yeah.
was the messaging from that episode. I'll make sure to link it somewhere so people can check it out. So final question. What is your best and worst investment deal? Like, what was your best and worst investment moment for you personally, not a client story?
Oh, for me personally. So
Yeah.
there have been one of my best investing moments is
Yeah.
I was looking to buy a house and I had that money invested and I had been saving for about 7 years and investing it
Okay.
to buy the house. And I didn't quite know when we were going to do it, but I knew we were going to do it. And I just happened to pull it out before the tariff and trade war stuff kicked off recently and the market dropped. So
Oh.
I happened to time it right. But the thing that
Yeah.
timed it right was the fact that I'm about to buy a house. I know I'm going to do it in 6 months. I followed the financial planning rules and it worked out great. And I didn't care that the market dropped. I mean, I cared because of my other money and my clients' money. But regarding my goal to purchase the home,
Bad house.
I was able to do it because I followed the rules, and for me, that's a win, because sometimes the other stuff, some of the bad stuff I've done where I'm like, "Oh, I'm gonna invest in a very complicated strategy," and then you're just like, "I think the market's gonna do this," and you go and do it, and you just lose the money, right? I've done that a couple of times. I don't tend to do that a lot, but sometimes I do it for
Yeah.
fun with a small amount of money, and I have at times lost, more money than I would have cared to by doing some stuff that would either pay off very high or you lose it all. And if you do it in small pieces, you can recover. But I've done that a couple times. So that's some of the bad stuff. But the good stuff is follow the rules, and these simple rules generally work. They're not going
Yeah.
to make you like super rich, but they stop you from being poor. That's for sure.
Okay. Your worst investment moment?
Worst investment moment would probably be one of those very high risk, like using option strategies where I was like,
Oh, options.
if you use options, it's like an all or nothing in a lot of ways. And you say, okay,
Yeah.
I'm basically betting that the market is going to hit this point by this time. And if you're
Yeah.
wrong, the money you put in is gone. So I've done that a
Yeah.
couple
One
times.
thing
But
I
with
like
small
about
amounts,
options
small
is
amounts.
it takes the concept of high risk, high reward. So you're betting at a very high pedestal, and once you hit it, you hit it. Like, there's no going back. But once you don't hit it, you crash down and you're like,
Oh,
oh
it's
no.
brutal. Yeah.
It's
I'd say one of the
brutal.
worst ones is when I was like, well, I'm going to exit this options position
Hmm.
if it's not going my way by this date. But the problem
Yeah.
is the liquidity on that particular option was too low, so I couldn't exit it. I put in orders to get out and I got out, but I had to take a haircut on the price because the liquidity for that option for the specific one I had chosen wasn't there. It was for other options for the same investment. So I
Okay.
made a misstep with the liquidity and I took a huge hit for that particular position. And part of it I couldn't get out of period and then the option went to zero. So,
Wow.
expiration. So that was not a good time for a couple $1,000. You know.
So when you're not advising people about money or making costly options mistakes, how do you unwind and reset?
I do dog training for a hobby. So I have
Oh,
2 dogs that we hang
really?
out with. I do some of
Nice.
that, and I do some woodworking as well. I build
Okay.
furniture, tables, things like that, and then I do some music as well. I play piano, keyboard,
Okay.
synthesizer, things like that. So that's what I do for
That's a
fun.
very chilled line.
Yeah.
I like the fact that you're very intentional about everything you do, intentional about financial planning, intentional about your hobbies. Because some people say, oh, I like to do this, this is my hobby, but they never really do it. It's like, okay, when was the last time you did that? So I like the fact that you take out time to break away, to do things you actually love and build something out of it. But Chris, it's been phenomenal having you on the pod today. And I know that a lot of people would want to reach out to you and continue this conversation. So how can we reach you, your socials, websites, and all that?
Folks can find me on LinkedIn. They can also find me at greatpath.com. And then there's a contact me form if they want to reach out and have a discussion about these kinds of things. And then you can also see the Golden Knot book as well on Amazon.
Amazing. Thank you so much for being on the pod today.
All right. Thanks, Stephanie.
Yeah, and there we have it, guys. Chris has basically broken down financial planning step by step for us. He gave us tips for the Gen Z population, the Millennial population, and even the baby boomers. And he gave us a holistic approach on how to intentionally start investing. And he said something that is profound. The best move you have to make to give you that financial calm is to set your emergency fund. So let us put it as a goal for 2026. Set your emergency fund today. Build it up so that you can have something to fall back to. And it's not money you're going to put in the stock market. It's money you're going to put sitting in a high yield savings account so you can get that money when the emergency hits. So till we come your way again next week, let's continue to turn knowledge into action and bricks into banks. This has been Bricks and Banks with Steph, and this is me signing out.